Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. So today we're opening up a recent business review. It covers Q3 2025 performance for, well, a real giant in semiconductor manufacturing.
Yeah, a foundational play. And this isn't just, a quick look at revenue. It's pretty comprehensive, gives us a good picture of the whole chip ecosystem.
Exactly. How healthy is it? What's the pace of recovery really looking like?
Mhm.
And maybe most interesting, where are they placing their strategic bets for, say, the next 5 years?
Right. And our goal here for you listening is to kind of cut through the usual corporate speak.
Yeah, pull out the key financial decisions. I mean,
Yeah.
there's some aggressive restructuring mentioned here we need to unpack.
Definitely. And understanding the nature of this recovery, is it fast, slow, bumpy?
And identifying those shifts, manufacturing footprint, market focus,
Yeah.
what's changing. We want to give you the insights that sort of define where things are headed through 2026.
Makes sense. And actually, before we even jump into Q3 specifics, there was some pretty significant news just before this review dropped.
Oh, right, the leadership news. The CEO,
Exactly. Elected chairman of the board. That takes effect January 2026.
which isn't just shuffling titles, right? It signals something deeper.
Totally. It screams long-term confidence in the strategy. And that's, absolutely vital when you think about the scale of their investments. Multi-billion-dollar, multi-year manufacturing projects.
That continuity is key because these big projects like building out new fabs, they need planning horizons way beyond a typical CEO's tenure sometimes.
You got it. So this allows them to commit confidently to those long-term strategic investments, making sure that manufacturing muscle stays their competitive advantage.
Okay, good context. So let's pivot to the Q3 2025 numbers themselves, like the headlines. Revenue,
Came in pretty much exactly as they expected, $4.7 billion.
hitting the target. In this kind of environment, that's notable in itself.
It really is. And that $4.7 billion, it represents a solid 7% increase sequentially. So up from Q2,
Okay, and year over year.
even stronger. Up 14% compared to Q3 last year.
Right, so that 14% year over year, that really confirms we're past the bottom of this cycle, doesn't it?
I think so, yeah. It shows a defined growth phase is underway, even if the overall pace feels a bit measured, as we'll get into.
And it wasn't just one product carrying the load, right? How did the segments look?
No, it was pretty broad-based growth, which is always a healthier sign. Analog revenue, that's their biggest piece. It was up a strong 16% year over year.
16%, okay.
Embedded processing also solid, up 9% year over year. And even their other segment, which is kind of a mix of things, that grew 11% compared to last year.
So seeing double-digit growth year over year in, pretty much all the major areas, that reinforces the idea that the recovery is structurally sound, even if it's not maybe explosive.
Exactly. It's happening, it's real, it's just moderate.
Okay, so those headline numbers paint a positive picture. But when you dig into the management commentary, there's this recurring theme about the speed of the recovery.
Yeah, that's definitely the dominant narrative coming out of this review.
So what's the core thesis? What's going on with the macro situation, and how's it hitting demand?
The key takeaway, and they repeat this a few times, is that the recovery is, without doubt, continuing. But the momentum, it's just slower, much more moderate than what we've typically seen in past semiconductor upturns.
Lower, more moderate. Okay. And they're linking that directly to...
Directly to the broader macroeconomic picture. Lingering concerns about inflation, just a general sense of uncertainty hanging over investment decisions globally. It's a recovery, yes, but everyone seems to be proceeding with caution.
That caution definitely influences how customers behave. But wasn't there a really positive structural shift mentioned? Something about inventory clearing up.
Yes, that's a huge point. A major hurdle seems to be cleared. For, the last 18 months or so? The industry was kind of bogged down because customers were just burning off the excess inventory they built up during the pandemic boom.
Right. They weren't placing many new orders because they were just using up what they already had.
Exactly. But the review confirms that phase seems to be definitively over now. Customer inventory levels are described as low.
Which means?
Which means any future demand increase has to translate more directly into new orders. The plumbing is cleared, so to speak. The stage is set for a ramp-up, even if the trigger hasn't quite been pulled yet.
Interesting. Let's talk about this sort of feel of Q3. Management often gives these qualitative descriptions. They contrasted how bookings flowed through Q3 compared to Q2.
Yeah, they did. Q2 sounded pretty choppy. They used words like hectic and noted some softening, which they largely tied to the immediate impact and uncertainty around new trade and tariff discussions back then. Orders were volatile.
Okay, so Q2 was bumpy. How did Q3 compare?
Q3 was described as a return to normalcy. Linearity was as expected. It followed a much more typical, predictable, cyclical recovery pattern. Demand seemed consistent across July, August, September.
That normalization sounds important, especially for what they call the turns business.
Very important. That turns business, basically. Those quick turnaround, often unplanned orders. It also followed the expected seasonal recovery trend in Q3. That signals the underlying system is stabilizing, day-to-day demand is behaving predictably again.
Let's just pause on that turns business idea. For listeners who might not live and breathe this stuff, can you quickly explain the difference between that and the more scheduled forecast business?
Sure. It's critical for reading the market's temperature, really. The scheduled forecast business, that's high visibility. Customers plan orders months out, giving manufacturers like this one a pretty stable view of future revenue.
Okay, predictable.
Right. The turns business, though, is low visibility. It's immediate demand. Short notice orders could be for unexpected spikes in consumption or just-in-time inventory top-ups.
Got it. So the fact that turns business is following a predictable pattern now is good. It means things are stable.
Exactly. Day-to-day consumption is stabilizing. But the fact that turns aren't going through the roof suggests customers are still hesitant. They aren't yet committing to huge, new, long-term projects that would drive a surge in those immediate, unplanned orders.
Okay, that makes sense. Let's break down performance across the key end markets then. 5 main ones. We have to start with industrial, right? It's usually the biggest.
Yeah, the behemoth. Industrial showed a really impressive year-over-year increase, about 25%, which points to strong underlying long-term demand in that sector.
25% year over year is strong, but sequentially, from Q2 to Q3,
That was much flatter, only low single digits growth sequentially.
which on the surface might sound a little underwhelming.
You might think so initially, but management actually framed this as a good result. The context is that Q2 was exceptionally strong for industrial, and historically, the transition from Q2 to Q3 in industrial is often slightly down. Okay, so any sequential growth at all, even low single digits, is actually a sign of continued underlying strength, despite that broader market moderation we talked about.
Precisely. Context is everything there.
All right, shifting gears, automotive. Everyone watches automotive for that long-term, stable growth, high-chip content story. How did Q3 look?
Automotive looked very resilient. It posted upper single-digit growth year on year, and sequentially, it was up about 10%.
10% sequentially is quite strong.
It is, and the crucial detail they highlighted was that this growth was global. It wasn't just one region. They saw it across North America, Europe, Asia.
Any color on why they were so resilient?
They emphasized that the trough, the bottom of the recent automotive downturn, was actually pretty shallow for them specifically.
Shallow trough, meaning?
Meaning, unlike maybe some prior cycles where auto demand fell off a cliff, their ability to consistently supply crucial components, partly thanks to their internal manufacturing capacity, kind of shielded them. They didn't experience the same deep dip as perhaps the broader market. Makes sense. Okay, so industrial was solid year over year, steady sequentially. Auto was resilient globally. Which sectors were the real powerhouses this quarter, especially sequentially? Where was the big near-term demand?
That distinction definitely belongs to two segments, and they kind of share a common driver: enterprise systems and communications equipment.
Okay, tell me about enterprise systems first.
Enterprise systems grew a phenomenal 35% year on year, but the sequential growth was explosive, up about 20% just from Q2.
Wow, 20% quarter over quarter.
Yeah.
And communications equipment.
Also surging, up about 45% year on year, which is huge, and still managed 10% growth sequentially.
Okay, those numbers are really jumping out. What's driving that?
It's a clear signal. While the general industrial economy might be tapping the brakes a bit, the huge structural demand drivers tied to digital infrastructure, think cloud, AI, massive compute needs, those areas are investing heavily right now with a sense of urgency.
Got it. That leaves personal electronics, usually a good indicator of consumer mood.
Personal electronics was steady. It grew low single digits year on year and picked up a bit more sequentially upper single digits.
So recovering, but not dramatically.
Exactly. It's recovering, inventory seems to be getting absorbed, but it hasn't hit that acceleration point we're seeing in enterprise and communications. Just kind of consistent for now.
All right, let's move to some operational factors. Pricing. Always a sensitive topic, especially when recovery is moderate and maybe volumes aren't exploding. Any unusual pressure in Q3? Did anything break their usual trend?
Nope, nothing unusual at all. Which is actually a pretty positive sign, right? Shows market health and probably reflects their strong competitive position, too.
So what are they expecting for the full year?
They're sticking to their initial assumption. They expect to end 2025 with a low single-digit decline on pricing on a like-for-like product basis.
Which is pretty standard in semis, isn't it?
Mm-hmm.
Slight price erosion offset by volume and complexity.
Absolutely. That's the historical model. So the fact that they're tracking exactly where they thought they'd be suggests the market is stable. No signs of, desperate price wars breaking out to move inventory.
Okay. And how about customer service? They've made these huge investments in internal manufacturing and building up strategic inventory. How did that pay off in Q3 in terms of keeping customers happy?
It seems to have paid off directly in terms of reliability. Their stated goal for building that inventory buffer wasn't about maximizing short-term factory usage. It was always about guaranteeing high levels of customer service and maintaining short, competitive lead times.
And did they achieve that?
The review confirms they did in Q3. Lead times were consistent, reliable. In fact, they suggested their service levels are so good, it might actually explain some of that low visibility in the turns business we talked about earlier.
How so?
Well, if customers know they can get components quickly and reliably whenever they need them, they don't feel the need to place massive buffer orders themselves or send out frantic turns requests. They trust the supply chain. So high service levels can actually dampen the appearance of urgent, unpredictable demand.
Okay, let's pivot to the financial mechanics behind all this in Q3. Gross profit came in at $2.7 billion. That resulted in a gross profit margin of 57%.
Yeah, 57% is a very healthy margin number on its own. But the really critical detail there is the slight sequential decrease. It was down 50 basis points from Q2.
50 basis points. 0.5%. Not huge, but significant. And that little dip, is that the first clue about some of the strategic trade-offs happening internally?
Exactly. It foreshadows the utilization discussion we need to have. Now, on the spending side, operating expenses, or OpEx, came in at $975 million.
How does that compare?
It was up 6% from a year ago. That 6% year-over-year increase points towards, the costs associated with ramping up these massive new manufacturing sites. You've got hiring, training, equipment installation, and crucially, the depreciation starting to hit on those huge assets before they're running at full steam.
Right. You have to spend money to make money, especially with fabs. But looking ahead, management guided OpEx to be flat sequentially in Q4.
Flat sequentially, yes, but, and this is a really important point for you listening, that flat projection specifically excludes the big one-off restructuring charges that actually impacted the Q3 results.
Ah, okay. So the underlying run rate might be flat, but there was this big charge in Q3 we need to address. That brings us to net income.
Right. Net income was reported at $1.4 billion, which translates to 1.48 cents per share.
But the catch is?
The catch is that $1.48 EPS included a $0.10 per share hit that wasn't in their original guidance for the quarter.
10 cents is significant, and most of that was this restructuring.
Exactly. 8 cents of that 10-cent reduction was specifically tagged as a major restructuring charge. And this isn't just trimming costs. It signals a pretty fundamental shift in how they manufacture and where they're focusing R&D.
Okay, let's unpack that restructuring. What was the main driver behind it? What's the strategy?
The catalyst, they said, is purely strategic. It's about driving operational efficiencies to get aligned with their long-term strategy, transitioning everything to the most modern, cost-effective manufacturing possible.
And the biggest piece of that?
The most profound element is the planned closure and wind down of the company's last two 150-millimeter fabs.
150 millimeter. Those are the older 6-inch wafer fabs. Huh?
Exactly. Legacy technology. One's in Sherman, the other in Dallas. These are the last ones they operate.
Wow. That really is the end of an era for them. Closing the 6-inch fabs marks that final push towards the big, modern 300-millimeter manufacturing scale.
Totally. Older, smaller fabs just inherently have higher operating costs per chip and lower yield efficiencies, especially for the more advanced processes they focus on now.
When did this closure process actually start? Is it done?
It's actively happening right now. The review indicated that these two fabs started processing their very last wafers in October 2025, so just after Q3 ended.
Okay, the lines are stopping. But the financial benefit, the actual cost savings hitting the P&L, that takes time.
Right. It'll be gradual. The savings from reduced labor, utilities, maintenance, all that. They expect that to be realized progressively through the first half of 2026. So it's not like flipping a switch for instant margin improvement. It's a systematic, longer-term pruning of the cost base.
Important to remember, it wasn't just about the factories, though. The restructuring also involved R&D, didn't it?
Correct. The other piece was consolidating some R&D sites. Management basically looked at their research portfolio and certain physical locations and decided the returns weren't meeting the high bar needed to support their long-term growth ambitions.
So, focusing their innovation efforts.
Pretty much. Consolidating these sites means they can focus capital, engineering talent, and resources more squarely on the most promising areas, particularly those tied to the big growth markets like data centers and high-value automotive applications. It's about ensuring every R&D dollar spent has maximum impact.
Okay, let's circle back to inventory, but look at it through the lens of factory utilization now, because this seems to be where the really intentional financial engineering is happening. Inventory ended Q3 at $4.8 billion.
Which equals about 215 days of inventory on hand. That was actually down 16 days sequentially from Q2.
And management seemed happy with that level.
Yes, they basically said they've hit their target. They reached the inventory level they felt was necessary to guarantee that high level of customer service and those competitive lead times globally. But crucially, once you reach that optimal level,
The focus shifts to maintaining it, right? Not letting it grow further, especially if revenue might dip slightly in the next quarter.
exactly. And that brings us right to the mechanical link between the Q4 revenue forecast, that inventory target, and the decision they made to lower factory loadings or utilization.
Right. Explain that connection. Why deliberately choose to lower utilization when you know it's going to hurt your gross margins in the short term?
It's a calculated, intentional management decision. It prioritizes long-term stability over smoothing out quarterly margins. Think about it. If your Q4 revenue guidance is lower than Q3's $4.7 billion, let's use the midpoint, say $4.4 billion, and you keep loading wafers into the factories at the same Q3 pace.
You just build up more inventory than you need, it would go above that 215-day target.
Precisely. So to prevent inventory from ballooning, management made the conscious choice. They moderated factory loadings, adjusted them down in Q4, following some moderation they already did in Q3.
And this is where that short-term pain for long-term gain shows up clearly on the financial statements. Because when you lower utilization,
Your fixed costs get spread over fewer units produced. And the biggest fixed cost for a chip maker is depreciation, especially on those brand new multi-billion-dollar fabs they just built.
like the big one in Sherman and Lehigh 2 in Utah.
Exactly. Those sites carry massive fixed depreciation charges every single quarter. When those factories aren't running full tilt, that depreciation expense per chip goes up significantly. That directly increases your cost of goods sold and puts immediate downward pressure on gross margins for Q4.
So they're choosing to take a deliberate, temporary hit to Q4 gross margin.
Because they view maintaining that optimal, non-bloated inventory level, which ensures superior customer service, as a higher strategic priority than hitting a specific gross margin number for just one quarter.
That really clarifies the guiding principle here. It's not about maximizing profit this quarter.
Absolutely not. The whole corporate mindset seems laser-focused on maximizing long-term free cash flow per share growth. Short-term margin swings due to utilization adjustments, they see that as necessary noise you have to accept to prioritize the customer. They've successfully ramped the capacity, built the inventory buffer, and now they feel ready to serve whatever demand comes next year reliably.
Okay, zooming out again. Capital management and cash generation. How strong was the cash flow in Q3?
It was really robust. Cash flow from operations hit $2.2 billion for the quarter.
And looking back over the last year,
Even more impressive, their trailing 12-month free cash flow reached $2.4 billion. That's up a massive 65% from the prior year period. This kind of cash generation is what underpins everything else, all those strategic capacity investments.
and they kept investing heavily in Q3.
Oh, yeah. Capital expenditures were still high at $1.2 billion in the quarter. Shows that continued commitment to pouring money into their core advantages, that leading-edge manufacturing capacity, and their proprietary technology development.
That strong cash flow also supports returning to shareholders, which is a big part of their story.
Huge part. Their stated strategy is centered on returning all free cash flow to the owners over time. They paid out $1.2 billion in dividends just in Q3. And, maybe more significantly, they announced another dividend increase 4% back in September. That marks the 22nd consecutive year they've raised the dividend.
22 years straight. That signals real confidence in the long-term cash generation ability across any cycle.
Unwavering commitment to that policy.
We should also touch on the government support they're getting, the CGPS Act money.
Right. That's starting to become tangible now. They noted receiving $75 million in direct funding related to CGPS Act incentives during Q3.
That's a decent chunk of change.
It is. It adds to their overall liquidity and ability to invest. And if you look at the trailing 12 months, their free cash flow figures now actually include a pretty substantial $637 million received from CGPS Act incentives. So these government programs are providing real, measurable financial support for these big domestic manufacturing projects.
Okay, let's shift focus now to the future. What did the guidance for the fourth quarter of 2025 tell us about the immediate road ahead?
For Q4, they projected revenue in a range between $4.22 billion and $4.58 billion.
Okay, so the midpoint is around $4.4 billion, which is down sequentially from Q3's $4.7 billion, aligning with that decision to lower factory loadings.
Exactly. And for earnings per share, the outlook was set between $1.13 and $1.39 per share.
Now, within that EPS guidance, there was a specific assumption change that helps them, right? Something about taxes.
Yes, a pretty significant structural tailwind, actually. The Q4 outlook assumes a much lower effective tax rate, down to about 13%.
13%, that's quite low. Why the change?
It's a result of new U.S. tax legislation that favorably impacts them. And crucially, management indicated they expect this lower rate somewhere in the 13% to 14% range to likely stick around for the entirety of 2026 as well.
So that's a nice, sustainable boost to net income going forward.
Definitely a positive realignment for their financial structure.
How does that Q4 revenue guidance, that $4.22 to $4.58 billion range, fit into the normal seasonal pattern for this company or the industry?
Management described the Q4 guide as being roughly seasonal. Meaning, if you look back historically, the sequential move from Q4 into Q1 is typically slightly down. Given that the recovery right now is moderate, not accelerating sharply, guiding for a seasonally typical Q4 aligns with that cautious pace. They're basically signaling stability, not an imminent boom.
Okay, so stability, moderation, we keep coming back to that word moderate. What did management specifically point to as the main thing holding back this recovery? What's preventing it from becoming the sharper upturn we've seen in past cycles?
The CEO is quite direct about this. The continuing drag is what they called customer hesitancy, a kind of perpetual wait-and-see mode. And this was particularly noticeable, they said, in the large industrial sector.
Hesitancy about what specifically?
About committing to big investments, new factories, significant capital expenditure plans, major new projects. Customers are basically holding back on pulling the trigger for large-scale CapEx.
And what's driving that hesitancy? What are they waiting and seeing for?
It really boils down to a lack of clarity on the geopolitical and regulatory front. Customers are waiting for final answers on fundamental questions like, what will the final global tariff rates actually be? Where is the best, most stable place to locate a new factory, given evolving trade rules?
So if you're planning a massive, multi-billion-dollar facility, you need certainty on your supply chain costs and the rules of the game before you commit that kind of capital.
Exactly. That uncertainty creates a bottleneck. It prevents companies from making rapid, large-scale investment decisions, and that's what keeps the current moderate demand environment from suddenly kicking into a higher gear, that sharp recovery mode.
Okay, so general industrial demand is being held back by this uncertainty. But there was one major exception mentioned, right? A market that isn't hesitating.
Yes, the huge outlier here is the data center market. It's the complete exception to this moderation rule.
That's happening there.
It's just an undeniable accelerating growth story for them. They described it as currently their fastest growing market, running at over 50% growth year to date compared to last year.
50% year to date.
Wow.
Yeah.
This whole sector, driven by AI, cloud buildouts, massive enterprise computing, needs its investing heavily and moving incredibly fast. Management said they see absolutely no slowdown visible there. It seems almost immune to the broader CapEx hesitancy affecting the industrial base.
And this explosive growth is leading to a change in how they report things.
That's right. Because the data center business has scaled so quickly and is clearly so vital to their future strategy, they announced plans to officially break it out. It will become its own dedicated, reportable market segment starting in Q1 2026.
Which gives everyone much better visibility into this key growth engine.
Exactly. It pulls this high-growth asset out from being hidden within other larger, slower-moving segments.
So before this breakout happens next year, where does all that data center revenue actually sit in the numbers we see today? It's scattered.
It's currently spread across 3 of the existing segments. The biggest chunk is sitting within enterprise systems that make sense. It's related to the actual compute gear in the data centers.
Okay. What else?
A significant piece is also inside communications equipment. That relates to all the networking stuff, wired comms, high-speed switches, the critical optical modules needed for bandwidth.
Right, the plumbing, any other places.
And interestingly, some of it is even classified under the industrial segment right now. Specifically, things related to high voltage power delivery systems, the big power supply units, PSUs, and architectural shifts within data centers towards using high voltage DC power.
Fascinating. It really touches multiple parts of their portfolio. So this business that's soon to be its own segment, how big is it right now? What's the run rate?
They estimated the current data center run rate for 2025 is approximately $1.2 billion.
$1.2 billion. Okay, yeah, that definitely warrants its own reporting line. It confirms they have this massive, fast-growing structural engine that's running somewhat independently of the broader industrial cycle.
Absolutely. It's a core pillar of their future growth story.
Okay, one last piece on the outlook. Let's talk about their long-term capital expenditure plans. They had previously set out a pretty wide framework for future investment. How is this moderate recovery impacting that view?
Yeah, they had established this very ambitious multi-year CapEx framework, targeting somewhere between $20 billion and $26 billion in total spending over that period. Huge numbers.
20 to 26 billion. But
now, given the reality of this moderate recovery pace, the ongoing external uncertainties, that customer hesitancy we discussed, management is signaling that future CapEx spending is probably more likely to land towards the lower end of that $20 to $26 billion range.
So maintaining capital discipline while things are uncertain, but keeping the option open to ramp if needed.
That seems to be the approach. They're preserving the flexibility to accelerate spending if the market suddenly takes off, but they aren't going to spend aggressively just to hit the high end of a target if the demand isn't clearly there yet.
But this adjustment in potential CapEx spending, it doesn't change their ultimate goal, does it?
Not at all. This is just tactical flexibility. The strategic North Star remains absolutely locked on maximizing long-term free cash flow per share growth. Whether the cycle unfolds quickly or slowly, they'll adjust the CapEx lever dynamically to meet the demand while always prioritizing that core financial metric. They want to avoid wasteful spending. #outro.
All right, that was a lot to unpack. Let's try to synthesize this for you, our listener. If you had to boil it down, what are maybe the 3 most important concepts to really internalize from this whole Q3 review and outlook?
Good question. I think there are 3 main pillars here. First, you've got that strategic financial trade-off they made. Management showed, I think, pretty rare discipline by intentionally choosing to let Q4 gross margins take a hit from lower utilization.
All in the name of maintaining optimal inventory and keeping customers happy long term.
Exactly. That's pillar 1, prioritizing long-term stability over short-term margin smoothing. Second, you need to really grasp the nature of this recovery. It is happening, it's persistent, it's broad-based underneath.
But it's moderate, constrained by external factors, particularly that macro uncertainty and regulatory hesitancy.
All right. Moderate but persistent. That's pillar 2. And third, you absolutely have to see the huge accelerating strategic shift towards the data center market. That $1.2 billion run rate, the 50% plus growth, that's the clearest signal of where their future focus lies.
Okay, trade-offs for stability, moderate recovery, and the data center surge. Got it. Now, looking ahead into, say, the first half of 2026, what specific things should you be watching most closely to see if these strategies are playing out as planned?
I keep 2 main things circled on the calendar. First, watch for the actual realization of those cost benefits from closing the old 6-inch fabs. That should start trickling through and supporting the cost structure, maybe helping margins, by mid-2026. We need to see if that happens as planned.
Okay, track the cost savings. What's the second thing?
Second, watch for that official breakout of the data center market in the Q1 2026 reporting. That'll be the first time we get a clean, transparent, dedicated look at that $1.2 billion plus engine. Seeing its growth rate separate from everything else will be really telling.
Great point. Okay, that brings us to our final provocative thought for you to mull over. We've established the industrial recovery is moderate because of external constraints, lack of clarity on tariffs, regulations, where to build factories. So the question is, what specific external clarity, be it macroeconomic news or geopolitical resolution, what would need to happen to instantly flip the switch? To turn this moderate industrial recovery into a much stronger, more typical V-shaped recovery the industry often sees? And, maybe more importantly, how fast could this company, with its inventory already built up, actually capitalize if that switch did get flipped?
That's the multi-billion-dollar question, isn't it? I mean, think about it. If, hypothetically, we suddenly got definitive finalization on major global trade rules, maybe clear long-term tariff structures are announced, companies get certainty on where they can confidently locate huge new CapEx
That
projects.
would unlock a huge amount of pent-up demand, or
Yeah.
especially in industrial.
Almost overnight, potentially. Years of delayed projects could get greenlit. Now, for this company specifically, because they've already spent the money, taken the Q4 margin hit, and built up that $4.8 billion in strategically managed inventory, they are uniquely positioned.
How so?
Unlike competitors who might need 6, 9 months, maybe longer, to restart mothballed lines or fully ramp up new capacity, this company is essentially sitting there, ready. They could arguably supply a sudden, sharp acceleration in demand almost immediately. They could turn that carefully prepared inventory into high-margin revenue almost instantly.
So the foundation they built, even at the cost of near-term margin, gives them incredible responsiveness if the environment suddenly improves. The uncertainty is the bottleneck, lift it, and they're poised for an explosive response.
That's the theory, yeah. They've built the launch pad. Now they just need the external go signal for liftoff in that broader industrial market.
A critical point to end on, indeed. The manufacturing base is ready, leadership continuity is there. Now we watch the macro factors. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.